the ending of the KOLs, the key opinion leaders. All these KOLs are going to get carried out in a stretcher and get hurt. We have Thomas Lee. He's like, I'm buying Ethereum. By the way, we were buying Ethereum too in June. Then you got Kathy Wood, another KOL. Kathy, here you go. Have my Bitcoin. Michael Saylor. Michael, here you go. Here's my Bitcoin. It goes on. And the other people, right? If you're following a KOL, if you're an ideologue and you're worshiping at the altar of one of these ideologues, you're going to get hurt. You're going to get hurt.
How low do you think we can go, and when do you think it's going to bottom?
The trend. And my high level estimate to this. So OpenAI is the bubble, right? OpenAI is making up their valuations. Where are they raising money from? Maybe OpenAI is not even worth that because they've got $1 trillion in debt obligations in the form of contractual commitments, but they don't have revenue to back it up. OpenAI could be really bad. Okay, here's what it is. Finishing my coffee before I woke up. The left tail risk would be that Sam Altman's committing fraud at OpenAI, and he's misled and misrepresented investors.
Good morning, everyone, and welcome back to another podcast episode here on the Coin Bureau. Now, today, our guest is Ram Ahluwalia, the founder and CEO of Lumida Wealth. He's a well-known investor, analyst, and a regular guest on the Bits and Bips podcast, one of my personal favorites. So, Ram, welcome to the Coin Bureau.
Thank you, Nick. It's always great to be back. I think the last time we were here was in the wake of FTX, and it was the beginning/middle of another bear market. I hate to be the bearer of bad news because we were bullish in Q1 23 around Bitcoin.
Yeah, you are bullish. I think that's good. We always need to get you on to just dissect exactly what's going on. And you called following your analysis at Bits and Bips. You called this one quite some time ago, so congrats there. But before we dive in, guys, quick disclaimer: nothing in this episode is financial or investment advice. Please consult the disclaimer in the description for more information, and consult your financial advisor before making investment decisions. And now, Ram, there are many questions I want to ask you about so many topics, not just crypto, but given that this is a crypto native podcast, we got to start there. And as you've alluded to, WTF is going on because forget about even what happened last year and 10-10 and all of that. I mean, the past 2 weeks were quite brutal. And like I say, you called it right, being bearish at the beginning of last year, and it's been down since then. So let's start off with what the most recent event, and that's the massive sell-off last week that many are attributing to some sort of a fund blowing up. There's there's other theories around it's a high-risk IBIT options trades, etc. But how are you reading right now this current moment in the markets?
Yeah, let's zoom out and look at the bigger kind of like tidal forces. We just had an S&P finish 3 years that are up 70% when the average annual return in the market is 10%. All manner of animal spirit themes have worked extraordinarily well. AI stocks, quantum stocks, vertical takeoff and lifting, defense stocks, space stocks, biotech stocks. These are all themes within a bigger category I call animal spirits, right? Animal spirits is this term that John Maynard Keynes used to describe the life force and the vitality and the energy, the raw energy and passion of markets. It's a very powerful force. In fact, that theme has been the best performing category the last 3 years. It's destroyed the S&P and NASDAQ and all the rest. It's the fastest moving category and also has the highest risk around it too. So that category topped out in the summer of last year. That's what's happened. So it's not just Bitcoin, it's also other categories. Obviously the DATs and crypto, which are adjacent to this, but other categories also. Look at like Robinhood. They reported and they're down 10% after earnings. Robinhood's down over 40% from its all-time highs. Palantir's down well over 20% from all-time highs. It's in a bear market. SoFi is down in a bear market as well. These are all like the hot stocks, and they're all high beta, and they rolled over. So that's the bigger theme that's at work. And what's happening is like value is working. International value stocks. Pick a country, South America, pick a continent even, South Africa, South Korea. And within those countries, banks are working, things with free cash flow. So there's a pendulum between animal spirits, which is about the future, and then high free cash flow buyback strategies, and those are working right now. That's what's happened. This pendulum has shifted. So that within that context, that's you know, Bitcoin is on the wrong side of those forces, along with other high beta names. Does that make sense?
Makes sense. So it's more like a market shifts in the broader dynamics, and people indeed were on risk on, but and it's a one could assume then you're saying that Bitcoin is a risk on asset, and it should trade as a risk on asset, which kind of negates the notion that it's some sort of debasement trade or some sort of a digital gold. So you then think the whole notion of a Bitcoin as a digital gold and inflation hedge, the debasement trade doesn't gel.
Well, it's definitely a risk on asset that trades with other asset classes like software, for example. That's true. Should it benefit from debasement? In some sense, it should benefit from debasement, all things being equal. We're not going to see that as much until the high beta aspect of the asset class is neutered, right? So you remember in the 2023 so-called banking crisis, Bitcoin did really well when the Fed rolled out a policy program to let banks borrow from the Federal Reserve cheaply. Bitcoin did very well there. Bitcoin also did well, when the dollar was declining, etc. So I think there is something to be said there, but it's that factors outweighed by this other consideration around high beta.
So you don't think that anything specific in the crypto markets, I mean, like I mentioned before, people point to 1010, for example, and people who are crypto natives could have seen that even post 1010, some of these high beta names in the stock market, at least some did recover post that initial
They're
announcement
related.
of the tariffs.
Yeah, let me double click there. So now within crypto, we just talked about macro, big
Yeah,
picture,
macro,
what's
yeah,
going on at the
yeah.
forces level. Within crypto, now here's the thing: what happens in crypto is happening in these other markets too. There was a deleveraging event on 1010, which you pointed out, with the ADLs and the forced liquidations. People were hurt substantially. Now that happened in 22 with the unwind of Terra Luna. You had another deleveraging event there. It was a surprise left tail risk. No one saw it coming. Deleveraging events are bearish. You had a credit event in crypto. Now you had a credit event then. So yes, 1010 did accelerate this, but it would have happened anyway. Now, these issues are happening in other markets too, like AI. So what happens is people get really excited at the top of the market and they start buying stuff on leverage because it can number go up only. And they start buying the dip and they say, oh, well, I'm down, but it's going to bounce now. The fear greed index is at the lows. It says green. Let me go buy. And that worked during this bull market for 3 years. How am I not going to make money? So they buy. So they start levering up. But the dip keeps dipping. Then something breaks in the system. Happened to be 1010. Could have been something else. And then they get carried out. But that phenomena is happening in other kinds of markets too. Look at like the AI trade, for example, or look at the deleveraging happening in high beta stocks like Hims, Robinhood, SoFi, Palantir. People own those names on leverage also. They're following the same kind of logic, and they all own the same kind of securities. Like what I try to do is study like what are the segments doing in the market. There's someone out there. I make up this kind of fictitious name. I call it like West Coast Tech Bro, who owns like all those names plus Bitcoin plus Tesla. By the way, I consider myself a tech bro too. I believe in the promise of the future, productivity, abundance. I believe in decentralized money. I think there's never been a better time to be alive. I think governments need to be held accountable. I think you need decentralized money. So I'm there. Okay. I admire Elon Musk. I like Peter Diamandis and the X Prize and all the rest, right? Still, you can't believe your bullshit all the time. And sometimes it gets overpriced. And that's what's happening. That's what's happening. So another dynamic in this is the call it like the ending of the KOLs, the key opinion leaders. All these KOLs can get carried out in a stretcher and get hurt. We have Thomas Lee. He's like, I'm buying Ethereum. By the way, we were buying Ethereum too in June. In June, we wrote about that before Tom Lee did. He got on board. Like, I'm buying billions of Ethereum. Okay, Tom Lee, here you go. Have my Ethereum. Then you got Kathy Wood, another KOL. Kathy, here you go. Have my Bitcoin. Michael Saylor. Michael, here you go. Here's my Bitcoin. And it goes on and on. And the other people, right? There's the guy behind SoFi who went quiet. He got a job at SoFi. I'm sure he sold the stock there, but he didn't want to disclose that. Very convenient exit for him. These are old KOLs. Like, pick a KOL. Tom Lee's ETF is well below the highs. They're all lagging. So if you're following a KOL, if you're an ideologue and you're worshiping at the altar of one of these ideologues, you're gonna get hurt. You're gonna get hurt. That's what's happening now. Remember, Tom Lee said Bitcoin at 250K by end of the year. Now it's end of January. Ethereum at 10K. No, it's not. None of that's happening. So we are entering the phase of disillusionment. Remember that peak trough. It's a great picture. It's very accurate. This idea of you got peak euphoria, which we had. This is the other factor. So you had deleveraging, the ending the KOLs, and the third factor is the passing of the stablecoin bill. That was peak euphoria. Circle had gone public, went to stratospheric valuations. The P's didn't make any sense. The IPO boom was in full force, and that euphoria's marked the tops. This is a great quote from John Templeton: "Bull bears and in euphoria, they bottom in fear, despondency, and pain, and no one likes the asset anymore." So we had peak euphoria, then the unlock started happening. People started hitting sell, and another factor also the DATs, right? So IPOs are often top signals. You want to be in the early side of the IPOs, ride the wave, and then the beginning of the IPO market, you get quality deals like CoreWeave went public. I don't know, $40 a share. It's at 95 now. It did great. Quality deals in the beginning. It was cheap. Then you get deal quality gets to get very poor. So remember Robinhood. Robinhood took Figma public. It was their first and maybe only IPO deal. Down 80%. And it was overvalued. Like, the price to sales ratio was bananas, and it's still overpriced. It's still over. It was that bad. So now when people think about the IPO market, it's like a hot stove. When people touch that and they get burned, they pull back. They say, "Wait a minute, I bought that DAT, I bought BMNR, I bought SBET, I bought that thing. I thought these KOLs knew something. I bought the IPO and it didn't work." So they get risk averse. So risk aversion goes up. So people, that animal spirit's dynamic where people look off into the distance. We're going to space. We're going to Mars. We're going to conquer the asteroids. We're going to mine this stuff. They get in their turtle shell and they pull back. And that's what's happening. Changes the psychology.
Yeah, it's a very good point, actually. And we'll get onto all these other asset classes and stocks as well, because there's many others that are very overvalued that could be coming down to earth soon. But okay, so you mentioned John Templeton there, and the bottom of the bear markets are marked by mass despair and just max pain. So then this brings the inevitable follow-up question, and that is, how low do you think we can go, and where do you think that's going to? When do you think it's going to bottom? Where?
So I'm not a price targets person. I think price targets are like the illusion of control and false. It's not science, right? Like, I try to look at the trend, and my high level estimate to this, which I retain the right to revise with new incoming data, which is really the only way you can do this. Like, forget about price targets. A better approach is reassess, 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 reassess. That's it, with new information. There's path dependency is a real thing. Kevin Warsh as Fed Chair means something different than Rick Reeder means something different than Kevin Hassett. Policy matters. What Trump says or does matters. Trade matters. Right? Is Bitcoin identified as America First matters. All these considerations play into it. It's a dynamic. We have a dynamic system. People take different actions based on different path price evolutions also. So, but given where we stand now, I kind of expect that maybe around the fall of this year, you could get some durable lows. That's not to say you wouldn't get some vicious bear market rallies in between, but I think those bear market rallies will be sold. So perhaps, which would line up nicely with the 4-year cycle, coincidentally enough. But that's kind of becoming a self-fulfilling prophecy, it seems like. But maybe around then. So that'd be my my estimate. We did have so much pain last week, though. Like, you could get an intermediate low there. There was a big washout, right, Thursday of last week. So we'll see. But the question is, do you want to play in a bear market game? Like, do you really want to be the one that is trying to catch that low? You don't have to. The great thing about an asset like Bitcoin is that you can miss the first 20, 30, 40% of the move off the lows, and it's okay. It's okay to make peace with that. We all have to make peace with that. wait for the trend to change, wait for a buy pivot point, wait for higher lows, wait for maybe the 50-day moving average start pointing upward, wait for a rally that's non-consensus and hated. Wait for a rally that's happening, but everyone hates it. Like, no, it's still a bear market. Those are the kinds of things you want to look for.
It's a very good point that the trend is your friend, and especially with assets like Bitcoin, where the momentum and price action begets more interest in the asset class and more people will buy. So that's when you need to go into it. So you don't
Yes.
have to catch the bottom. So just going back to other asset classes and other stocks and stuff, if as you alluded to, the old guard high beta has sold off. You've mentioned
Yes.
Robinhood and SoFi and many others, and that people should consider portfolio pivots in terms of themes. So, like you mentioned, I think you put out a tweet: value stocks, international commodities. Can you expand on that a bit more?
Yes. The main message here is you kind of have to think and do the exact opposite of what worked in the last few years, which is very hard for people to do. This is the time for mental flexibility. You have to eat your children. You have to destroy these ideologues and do the exact opposite. Okay? Boring is good. Free cash flow is good. It's back to basics, back to classic investing. This is like the revenge of Warren Buffett kind of environment. By the way, I'm not saying buy Berkshire Hathaway or Costco. These are things that are way overvalued. But the idea of getting back to basics. One of the best asset classes in the world is banks, international banks. Santander is up 130% in the last year. You can pick a bank in any country. I'll tell you a bank that is doing really well. South Korea, KB Bank. It's up massively. It's like 50% in the last year. The banks in Brazil that are doing well, HSBC, UBS. Banks are the opposite of crypto, right? Crypto, decentralized money is about self sovereignty, not having trust requirements, having a decentralized immutable ledger as a record, and we can send and exchange value trustlessly without relying on the system, which was again engraved in permanence in the Genesis block. So that's the way you should be thinking. Like, what's the exact opposite? Go to that part of the world, and I think that will do well. And the reason why, it's like, why? What's the other idea here? What's happened is that you had so much crowdedness in these themes, and it's not just Bitcoin; it's also like Mag 7 stocks, which are lagging. The U.S. market, one of the best performing markets in the last 10 years, been phenomenal market, and it's been crushing international for all sorts of reasons. We know Europe has issues, or they're on decline. Their productivity growth isn't there. They're not encouraging entrepreneurship. They're taxing American companies. Only one country permits the sale of Teslas. It's absurd. We know they have a story where they're getting older too quickly, and so does Japan, and so does China. But they're all outrunning the U.S. market. So you can be right or you can make money. Which one do you want to be? You can be right intellectually, and you are right in some sense, but the time frame matters. And right now, if you want to make money, it's you have to do the opposite because the crowdedness. There's like a metaphor to think about this within. Sometimes you see these, like let's say you see the VIX spike when there's a lot of fear in the market, right? And eventually, that fear and panic releases. The same thing happens in asset classes. So, Mag 7 and Bitcoin and all these crypto assets, they got crowded. People chased into them. The valuations got bid up. Now, you can't put a valuation on, say, Bitcoin, but there are other proxy assets where you can. They all got crowded and expensive, right? You had a bank like SoFi that's trading at 60 times earnings. It's a bank. It's just a bank. At the end of the day, it's a bank, okay? Really expensive. So it's crowded. All that capital got into this thing, and then other things got dirt cheap. Like think of like a tsunami wave, right? All the water pulls out from the beach, and it looks very safe. And meanwhile, the tsunami is coming, and it's crowded, and then it comes crashing down. Those are the kind of metaphors to think about this within.
Yeah, the crowding misprices the risk. It eats into the risk premium you can potentially earn on some of these high value big name
Yes,
stocks. So then you pointed to the sell America buy Europe trade, which so far I think over the past year Europe and stock 600 significantly outperformed the S&P. So do you think this trend is still going to continue at least this year?
yes,
Are you
yes,
still allocating that way?
yes. It's sell the United States. By the way, I'm an American patriot. I believe in the values of the Constitution. I believe there's no better place to build a business, start a family. The productivity growth story is amazing.
But you're a
Yes,
capitalist, mate. You got to make
um,
money. That's all that matters.
yes, yes, exactly, right? So it's really sell America and buy almost anything else. It's not just Europe. Uh, South Africa, which by the way has a lot of miners, is outrunning the United States. Brazil, Mexico, Japan, South Korea, Vietnam. Vietnam's up like 70%. Greece, remember the pigs? Portugal, Italy, Greece, Spain. We made fun of the pigs, right? They hang out at the beach. It's a great place to be retired, play tennis, hang out, get the sangrias. All of them are outrunning the United States. All of them. By the way, the objects of Trump's wrath, China, Canada, France, they're all beating the S&P too. It's hard not to find a market beating the S&P. It's harder that. So it's like anything. Now the question is, well, how long will it run? So we look back after the dot-com bust. I'm not saying it's a dot-com bust, but things got expensive. History rhymes, it doesn't quite repeat, right? What you saw there is small cap value beat large cap growth. That's happening right now. It's happening now. Look at IJS ETF. Look at the Russell. Look at the Dow Jones Industrial. It's all-time highs. QQQ is not. These themes and patterns are everywhere, right? So the other part we saw after the dot-com bust is that emerging markets did really well, and international stocks. The same dynamic. The capital went from these crowded trades that got expensive into leaking everywhere else. And it's high torque because these are high market cap categories. And these other categories are low market cap. It's just a little bit of capital flowing into there. That velocity and torque gives them a lot of lift. That's what's happening. So we saw that when that happens, when you get 1 year of outperformance, the next year also does well. It's just getting started. It keeps going. And what's happening now is momentum is catching. So it's not just value and earnings growth and it started as a non-consensus rally, which was most of last year, but now momentum is catching. People are looking at it and saying, wait a minute, Santander's up 130% in the last year and it's still got a forward PE of 10 times earnings. To put in perspective, the S&P's got a forward PE of 22 times earnings. JP Morgan's at 16 or 17 times earnings. And they've got a good macro story, right? They're relaxing, they're doing wage reform, they're creating competition in the economy, et cetera. So is Greece. So that's why I think they have more room to run. Japan, too, they have a corporate reform story. They're enabling and encouraging more competition, more M&A, more shareholder-friendly regulation.
No, it makes sense. I'm curious then in terms of just coming back to right now, the tech sector. And as I mentioned, there's some sectors there on some stocks that many people are questioning it. And this comes to the point of the hottest sector of tech right now has been the AI trade, right? And indeed, we've seen it's quite a bit of a sell-off over the past few months. NVIDIA is down a lot. And I'm really curious to hear your thinking on this on a number of factors, because I think there's been a lot of bubble talk lately. And indeed, you recently tweeted wondering whether OpenAI is too big to fail and how it reminds you of mortgage securitization. So can you first expand on that thought?
So in AI, there's a big split between capex payers and capex receivers. Let me define that. So a capex payer. So what's a capex? It's a capital expenditure. It is an expense. Just to be clear, it's an expense. It's an investment in infrastructure, property, plant, and equipment. And OpenAI, Meta, and Google, a lot of these companies are investing over $1 trillion over the next 5 years in capex. So their expenses are going up. And then you have the capex receivers, which are companies that are providing the infrastructure, and they're the beneficiary of all that spend. NVIDIA is an example, the memory suppliers, Micron, SK Hynix, and the supply chain behind them are part of that, Lam Research, KLAC. The big winner in all this, in my view, is Taiwan Semiconductor, which we own. All roads go to Taiwan Semiconductor. It's up 50%. It's outrunning NVIDIA, by the way. And it's clean because it doesn't have a self-dealing. They're not making investments in their customers and round-trip trades. They're not getting the money back.
Circular financing, yeah.
It's clean revenue, clean earnings, and they're monopoly. Like the only game in town. Intel's gone. Global Foundries is not a real competitor. So all roads go to Taiwan Semi. It's a great name. You got to buy these well, though. The market knows this. You got to buy these well. What's happening with OpenAI is a bubble. Where's the bubble? It's in private markets. It's in venture capital. It's absolutely a bubble. Venture capital is one of the worst categories to own. I'll give you one quick data point. You have a company called Brex, which had a take under. It was bought by Capital One for $5 billion. Sounds great, but they raised money at around 12 billion in 2021. By the way, we had 20% inflation between 21 and now. So it's effectively down 70%. It's a take under. Databricks is raising money at ever higher valuations before their IPO. Meanwhile, SaaS stocks are in the dumps and never been cheaper. Databricks is a SaaS company. So in private markets, it's like funny money valuations. There's no discipline from mark to market. In public markets, these will not do well. It'll be like the next Figma, be down double digit. OpenAI is the same thing. So, NVIDIA hit $5 trillion and pulled back. It was a peak euphoria moment, $5 trillion, high five. They're like, yeah, champagne comes out, victory lap. We posted charts on Twitter, then we sell. I did that, by the way. I said, congratulations, $5 trillion. Then I thought about it. I was like, shit, I'm doing a victory lap. It's like, I'm doing
Yeah.
a victory lap. That means sell. So I did a
Yeah.
victory lap and I said, it's time to sell.
Yeah.
So
That's
that's
the
how euphoria works. And so OpenAI is the bubble, right? OpenAI is making up their valuations. Where are they raising money from? They're not raising money from Brad Gerstner or Altimeter. Remember, Brad Gerstner interviewed him in this disastrous interview in the end of October. And he said, Sam, I want to invest. And Sam went, it's kind of unhinged, lost the message in the frame, and he was trying too hard. People saw through it. And he's not investing. They're raising money from SoftBank, which is a terrible growth investor. They're raising money from these knucklehead sovereign wealth funds in the Middle East that they're not the smart money. They're not the smart money.
NVIDIA pulled their deal in them or their option to invest in them like 2 weeks ago as well, right?
Yeah, which is effectively NVIDIA conceding they're accepting lower margins. Now, look, I do think NVIDIA in the next 5 years will do well. Their earnings per share growth is 60 to 80%. Their PEG ratio is below 1. Like, they've got a good story, but it's complicated. Like, their effective margins are much lower because they're subsidizing their customer. That money is going to flow back to NVIDIA. But think about it this way: NVIDIA is buying into OpenAI at an $830 billion valuation when it's really worth maybe $100 billion or 150, and maybe less. Maybe OpenAI is not even worth that because they've got $1 trillion in debt obligations in the form of contractual commitments, but they don't have revenue to back it up. OpenAI could be really bad. Who knows? It's 100 billion, 200 billion. It's less than what it is now. So OpenAI, NVIDIA is making an investment that is 60%, 70% overvalued, but they're getting that money back in revenue. So it's not clean margin anymore. But TSM has clean margin. TSM not doing any of that. NVIDIA is then going to write a check to TSM, follow the supply chain. TSM is going to do well, and TSM has pricing power.
It's interesting you mentioned TSMC there as like a monopoly and one of your highest conviction plays in the AI meta. I'm curious though, ASML, have you guys looked into that?
I have. ASML is another monopoly. Here, it's done really well. It's not a bad idea. It is just getting more expensive. So this is a trade. You got to time these well. So when momentum breaks, I would sell those. And it has momentum right now.
It's got a lot of back orders. I mean, obviously they are the only monopoly. They're the monopoly out there for the lithography machines, and I think it's just interesting because they are up quite a lot. I think like over 70 to 80% in the past few months. But that's another. It's a play because it's AI, but it's also European. So
Yeah, let me see if I can share my screen here. I'll show you a quick view. One of my favorite charts to look at is a trailing valuation on a stock. So here's ASML. It's up as we speak. It's up almost 100% in a year, 40% in the last 3 months. And if I look at the valuation history, you can see it cycles. It cycles. Cycles are part of markets. You want to buy low, sell high. We're not at peak valuations, but you're getting close, right? This is more expensive than TSM. TSM is like half the valuation, right? So these are trades. You have to just be mindful of it. And when you see a trend break around this, I would sell. Now, everyone knew 2 years ago that ASML had a monopoly, and I used to own ASML back then. And then it won like this coveted prize at the Irisone conference. Irisone is this annual hedge fund conference where people pick an idea and they present it, and it won the Irisone prize. It became consensus, and that's when it lagged and went to bear market for the next 7 months. So this is a funny thing about markets, right? It's the same thing with like Bitcoin, same thing with Euphoria. When everyone's like, okay, we got it. We found the answer. You found your truth. There's an expression in Zen Buddhism, when you see the Buddha, kill the Buddha. Same thing. When you think you found it, market's going to rug pull you.
Man, that's so true. I mean, that's a maxim I should actually have on my screen as a best screensaver when you think you've seen the Buddha. um,
Right.
yeah, I'm curious then in terms of like because obviously many people, the optimists, the that are looking at AI right now, are saying, well, all of we've got it in terms of the AI spend, for example, right? Like, I think there was a stat, a crazy stat, that the four, like Amazon, Meta, Alphabet, and another hyperscaler, were basically spending this year, 2026. Capex obligations. They spend in like 2.1% of GDP, which is like 10 times relative to GDP that it cost to send people to the moon in the 60s. And it's the second only most expensive investment ever, only to the Louisiana Purchase. So there's this massive amount of capex going on into AI right now, this massive spend. And all the optimists are out there saying that, look, it's national security importance we need to get to AGI first. And this will obviously unlock all these productivity gains and help with the expansion of GDP growth with these productivity gains, deflation. So what's your view on that whole thesis?
I agree with I think everything you said there. I mean, AI is going to unlock a tremendous amount of productivity gains. It will improve the quality of life. It will improve earnings growth for companies. You are going to get a heightened competition. You got a lot of winners and many, many more losers. You're going to see industry transformation dramatically. Either you're AI native or you're AI not. You're going to have the AI haves and the AI have nots. You're going to see that the banking layer, Lumida is a wealth management company. We have our own AI app now. We want to go take out Morgan Stanley and JP Morgan. Why don't you just have an AI avatar that talks to you, meets you whenever you want? You can be in your PJs at 2 a.m. on a Saturday talking about NVIDIA, talking about your portfolio, getting ideas. That's the future. So yeah, people are diagnosing diseases with AI where doctors have failed to diagnose correctly for years. You're seeing home education transformation. So yeah, I think all of that is very real, and the spending is amazing, and it's not going to stop. It's not going to stop because you have trillions of market cap at risk. So if you're on the board of Google, Microsoft, Amazon, Tesla, and more, your job is to spend, because if you don't invest in AI and you lose the race for AI, if you don't get the next form factor, then your market cap is at risk. So you're willing to spend $100 billion a year on AI because you're defending $2-4 trillion of market cap, right? If Apple Series suck, we know that. We know it sucks. They know it too, right? And if people shift to Google Home, because now Google Gemini is good, Apple sees that. Apple has to invest. Apple's the most acquisitive name in AI right now. So competition's the enemy of returns. I think that focus on capex receivers, some of the names I'm talking about, that category of play is a good category of play. Buy it, buy well, buy at a reasonable price. Be mindful of the trend, make sure you're on the right side of the trend. Even good ideas and good stories can break, then get out, then get back in when people ignore it.
So tied to the AI build out, and this is something you recently said in terms of the concerns for AI are not on the software side, on the software models, but on the physical constraints, and particularly the high bandwidth memory and the supporting infrastructure, which makes the AI build out far more capital intensive, and many investors assume. And you've talked a lot about, I think you mentioned it, SK Hynix from South Korea, like memory producers. So can you expand a bit more in terms of your thesis of investing with these physical constraints in mind, be it energy or memory or other forms?
Yeah, those are all really good themes to own, right? So hardware-based memory is a core unlock. The backlog is significant. They have pricing power. There's a couple of players: Micron, Samsung, SK Hynix. SK Hynix is the leader. They're better than Micron, but there's no ADR. You can only get it by buying South Korea ETF, which is a good idea because the South Korea ETF not only has SK Hynix, but also gives you Samsung. It also gives you those international banks we talked about and other ideas that have meaner version like Coupang. So I like South Korea. So yeah, there's HBM is a good story. Memory is pro-cyclical. So at peaks they look cheap, and at bear markets they look very expensive because it's very pro-cyclical. They have a lot of operating leverage. So keep that in mind, right? This is one of those things where you just have to be on it and manage it well. But it's still cheap. 4P of Micron's like 10. And it's funny. Like I saw this AI thread go viral this morning. It was written by a developer who said that this Monday he was able to code an entire app. This is beyond vibe coding. Vibe coding, you need to edit, you need to re-engineer. It's not really sturdy. There are issues. You need unit tests. You got to think about the UX. But he was able to develop an app purely from high-level instruction and did it better than him and got it right the first time. So that's sending AI names rallying this morning as we speak. That's bullish for AI. Yeah, I think those capex receivers are I think those are good ideas. Just manage them well. Like you got to ask when do these names get crowded, right? They will get
Yeah.
crowded.
If you
Yeah.
look at the price of Micron over the past, I don't know, 6-7 months, I think that's got a lot of that is pretty well priced now, pretty
And
richly
the other,
priced.
you brought up energy. So energy, I love energy. Energy is less crowded. So nat gas, midstream, I love nat gas. So nat gas has to be part of the energy solution because it's clean energy, it's abundant, it's cheap, and you can invest in the grid fast enough. It's not going to be grid based solutions. You're going to have energy on site to power these plants. Like Elon has a data center in Memphis, one of the largest data centers in the United States, powered by natural gas. So that is a good idea. Nat gas midstream, of which there are many, Shineri, NLG, ET, Kinder Morgan. There's many of the MPLX, and they're all doing well. Which I like to see that they're all doing well, and they're not that expensive. They have earnings growth. There's also the generators attached to those guys are expensive, by the way. The generators are all expensive.
Curious though, in terms of speculative energy plays, have you looked into some of the nuclear fusion, nuclear,
I
some
have,
that are
I
coming to
have.
market?
I used to own some of these. I put this. Let me just take a look real quick where we are now in those names, kind of in real time. So this bucket falls under like the high beta idea, that theme we talked about. People have been talking about nuclear and uranium, and we're not going to see product market fit there anytime soon. Like we have not solved small modular reactors. It's been a known thing for years. The permitting's not there. The regulatory isn't there. The intentions are to get it right, but there's not in my backyard concerns at the state level. This is hard. There's uranium mines. They have title to the land. They're not actually producing much. They're expensive. So I put it in the high beta category. Like thematically, it's off theme at that level. So it's more of a trade rather than an investment, and you have to time it very well. I think there are names there that could be interesting though. Like I'm looking at the names now; they're selling off as we speak today. NVIDIA's up, ASML's up, Centrus Energy, which is a leading provider of HALEU, it's down 10% today. Aklo, let's take a look at Aklo. It's down today. It's in a bear market, right? High beta, back to the high beta theme. It's crowded.
No, that's fair. Speaking of crowded trades, and Elon, who you mentioned as well, there's a lot of very, very, very big IPOs coming up this year. Tesla, Anthropic, potentially OpenAI, and last week or 2 weeks ago, XAI merged with SpaceX. And that's probably going to be the biggest IPO ever. So I'm curious then, what are your thoughts on these upcoming IPOs? I mean, you've mentioned the fact that private market valuations are inflated and in a bubble, and now they're coming to the public markets. Is it going to be a down only?
Yes, yeah, you nailed it. You nailed it. Look, the first off, we do pre-IPO investment. We did CoreWeave. We've invested in Canva. We invested at Kraken at 12 billion valuation. So we do this stuff, and I look at opportunities all the time. We passed on Databricks, which is nonsense for the reason I mentioned earlier. I wanted to get Anduril. Now I can get to it. I'm not investing in that either. By the way, that probably does okay in pops anyway, just because of Palmer Lucky magic. But it's more speculation rather than investing. And I have opportunity cost of capital. I can do other stuff. So yeah, like the market can absorb trillions of dollars in new IPO issuance. It's a $60 trillion US equity market. SpaceX at $1 trillion doesn't make any sense. I was offered SpaceX at a 20% discount to the last round. Now they found me. That wasn't me looking for it. What do you think that means? What does that mean for the real price of SpaceX? It's not the sticker price. People are trying to sell and they're like, can I get 20%? What's the real price? The Tesla XAI deal, that's a lot of self-dealing, right? Elon's on both sides of the trade. Look, I have a tremendous amount of respect for Elon and his contribution to humanity. He's an extraordinary human being. We should all listen to what he has to say. His imagination, his work ethic, his brilliance is, he's at GOAT level. Okay, so like I'm in the fanboy club, just real clear. I have a Tesla. I see EVs as the future. That's all just self-dealing. He's pricing both sides of it. He's conflicted. He makes up a number in the same way Sam Altman makes up a number on the valuation. You get it done. Everyone's going along for the ride, and that's not a real, that's not a real thing. So we'll see if they actually go public. I don't know that they all will. OpenAI has to go public because they need the money. They need the money to spend. Otherwise, they will be in default of their contracts. So OpenAI will go public. Anthropic will beat them to the punch. And the fact that these companies may go public doesn't necessarily mean that public markets have to do well. I see this often. They say, oh, well, the big banks will make sure the market's up so they can take them public. That's not how it works. It's not a conspiracy theory where Wall Street says, okay, we're going to engineer the bull market here. Right? Those banks had just massive value destruction in the '08 crisis. I was at Wall Street. I was working at these banks. I can tell you, Lehman didn't say, let's go impale ourselves now. Bear Stearns didn't wake up saying, let's impale ourselves. Goldman and JP Morgan didn't say, let's take banking regulation and become a bank.
Yeah, no, it's fair. Wow. Moving on to other asset classes now. One of the others that has been just crushing it especially the end of last year, but more specifically at the beginning of this year, and has subsequently slightly retraced, is what's going on in precious metals. And you actually, I think it was three or 4 weeks ago, you called the exact top on gold, which is crazy. Which is crazy. So I'm just curious, what's your thoughts on the precious metals complex right now, specifically gold and silver?
So we actually, here's a funny thing. We bought those names after the rout. So we bought silver, we bought copper, bought some gold. So that was doubly satisfying. Let me pull. They're all at. It's in a highly reflexive moment right now. Markets are reflexive. This goes back to my point earlier about price targets. We don't need price targets. That's not the right way to look at markets. So the fundamental case for these commodities is there. China's got the bid for gold. They're not going to buy U.S. treasuries. They're not going to buy European bonds. What's left? What are they going to do with their foreign reserve surplus from exports? They have to buy something. They're going to buy gold. The fundamental story is there. The fundamental story for copper is there. It takes 18 years to build a copper mine. The demand is going through the roof due to reindustrialization and data center build out. Silver got a story. It's part of memory. They all have stories. But again, like nuclear, everything's got a story. And the cure for high prices is the high prices. Cocoa had a story. Remember cocoa went parabolic? They said, oh, went nuts over cocoa, then cocoa crashed. Copper in May of 24 went parabolic. I was listening to Bloomberg. I couldn't get in the car and turn it on. People aren't talking about copper. Then copper went bust. Copper rallied a few months ago, then that went bust. So just keep that in mind. It's not only about the fundamental story. It's about, is it crowded? And they're all correlated right now. So when one goes, they'll all go. That's one observation I'll make. So there's an illusion of diversification across these names. I think if you own one, you should probably own all of them because you're going to get diversification. Okay. I do like the copper story from a fundamentals perspective. I think it has more room to run. Let me just share my screen and walk through a few charts here with you all. This is it's at a highly reflexive moment right now. I would say it's like too hard to call. I own some copper, I own some of these commodities now, but it's not a layup where we stand now. Like markets, if there's a good impulse and it rallies higher, they'll keep going. But if markets sell off, then they won't. And literally it matters day by day. We just had this AI story come out this morning that went viral. ASML up, NVIDIA up. These names were poised to roll over yesterday. But now you have these shorts that are now wrong way positioned. They woke up, they saw the same article, they got a cover, you get a squeeze higher, and commodities are getting correlated with the AI story too. So it could go, but it is a hard call. Get a couple points exposure isn't a bad idea. If you see a parabolic extension, you have an inverse, then you should get worried there. Go ahead, yeah.
Yeah, silver and gold looked exactly like that, and it was what kneecapped the rally, or took the wind out of and then forced the deleveraging and the and the collapse on the long trades was the Fed announcement of Kevin Warsh, and then all these concerns. Oh, was he a hawk? And then, of course, oh, do we need the debasement trade anyway? And then, of course, all the highly leveraged silver positions, especially those coming out of China with the dislocation and the pricing on the Shanghai Futures Exchange versus the spot prices. It was crazy. So that was, again, come back to your point about leverage, right? As well, deleveraging. And that's why they've subsequently crashed. But the fundamental story is true, but it's like, pricing something fundamentally, what's the fundamental price something should be versus how much of that is speculative, how much of that is industrial, and how much of that is retail frenzy. It's hard to tell right these days sometimes.
Yeah, no, I agree. This is one of the most complex market setups we've seen in years. It's hard to give certain long range things I'm comfortable, like international value, international, we talked about that. Love that. Midstream nat gas, love that. But like on commodities and some of these names participating in the AI theme, these are more like late momentum ideas. So you have to be on the ball. Let me show you an example of what I mean. Like this is Caterpillar. Caterpillar is a boring old industrial stock, right? Everyone knows Caterpillar. It's like your grandma's and grandpa's stock. It's up 4.6% today. It's gone parabolic. It's at 116% return. This is Caterpillar, right? It's wild. It's wild. Caterpillar. This is more expensive than NVIDIA. It's got a 40 trillion PE from a valuation multiple perspective, right? Let me show you Caterpillar's PE ratio. It's never been higher, right? We're at all-time highs. So the market is saying earnings growth is going to step up, but these things are priced for perfection now. So this is momentum. This is all momentum. And, they have a backlog. Everyone knows the backlog is there.
I'm curious in terms of, because you've worked in TradFi, so have I, and momentum as a factor. If you think about factor investments, like factor funds, and how they usually allocate and weight things in terms of, like, you've got the momentums and you've got the fundamental factors and all that. And given that these stocks that are in the momentum bucket, how much of that is these funds allocating to stocks based on the fact that there is momentum behind them, and that
100%.
it's a lot of it, is it?
Yeah, a lot of it is that. So it's happening both at the quant fund level, at institutional level with the AQRs of the world, and also at the retail level. Momentum is a magical thing. And I like momentum too. Momentum is one of the powerful forces of the universe. Momentum, winners keep winning. There's a lot of late momentum out there, though. You want to get early momentum. You want to get transitions from those non-consensus hated rallies into momentum. Last week we saw a 3 standard deviation move in the momentum factor. It did really well, and then it got hurt a lot. So when you see those could represent transition points in momentum. Eventually, I think a lot of these late momentum ideas will break. They'll get too crowded, and the marginal buyer doesn't step in. And the folks that got in early, just like the OGs in Bitcoin in the cycle, they're just going to start hitting sell. Those are the informed parties where they're doing the deep work. They made money on their thesis. And this is how it always goes. Then you start seeing more insider selling. Track when insiders start selling these kinds of names. And there's never been a more complex time for positioning.
Yeah, it's true. It's tough now. You don't want to catch the top, but you still want to ride the momentum wave. So what stage are some of these names in the momentum?
Have a
In that
decision
wave?
rule. Write down your decision rule now so
Yeah,
you can maintain objectivity. Yes.
exactly. And the emotion should not be a component in any form in your
Yes.
investment.
Micron and ASML and SK Hynix, these names today are the Robin Hoods and Palantirs of last year. That's the way to think about it. The capital is rotating from that old guard high beta, and even new guard high beta's got issues. But these names, like there's such strong fundamental demand growth and the capex, which we talked about earlier, that they are catching. But that, maybe in a year that party's over. We'll see. You just got to stay on it.
Just quickly moving on to the macro picture right now. We've got a new Fed governor coming in. We'll see in May if he can get confirmed because of all the questions around Powell, the investigation, and all that, and the Senate. But he's basically been seen as a hawk, which I suppose just because of what he said in the past. But I'm curious in terms of how are you reading the macro tea leaves and how it feeds into the Fed policy And it's not just Fed policy, because as I think many people now see that the Fed and the Treasury are kind of going in tandem with some sort of an injection of liquidity on the Fed, and the Treasury is now thinking about short-term issuance and how they can potentially talk of, or
Yeah,
Kevin Warsh potentially even engaging in some form of yield curve control. But how are you reading
yeah,
the environment right now on the
yeah.
macro
That's a
side?
great question. So you'll definitely get that coordination, right? Kevin Warsh and Scott Besson are both students of Stanley Druckenmiller. Uh, Druck is pulling the puppet strings here in the back, and Druck and these guys have a view of get back to bits and atoms, physical world, infrastructure, and productivity growth, which I think is a great idea too. Like that is a good idea. Warsh is a hawk. He'd been a hawk in the 2010s. He was critical of QE, which was the right idea. He should have been critical of QE. This grand experiment in monetary policy shouldn't have been done. And he doesn't want to grow the Fed balance sheet. That's not good for speculative assets. All things being equal, it means you get a lower multiple on equities. Because if you shrink the Fed's balance sheet, then you are withdrawing liquidity from the system, right? Now, on the other hand, Trump wants someone that's going to cut rates. Trump wants his guy in there. Trump doesn't want Fed independence. Let's just call a spade a spade. Okay. Hassett would have been the right guy for Trump because he wants to cut rates. Rick Reeder would have been like Ram's favorite pick because Rick is the number one bond buyer of the world, and Scott Besson's the number one bond seller in the world. You get the dynamic duo. It's like Michael Jordan, Scottie Pippen. That would have been my dream team to see come together. Kevin Warsh Kevin Warsh is interesting. Now, think about Kevin Warsh. Well, one, he's a hawk. So either he's a hawk or he's not a hawk. He's actually dovish. So if he's dovish, it means he's going to do Trump's bidding, which means he's not independent. Neither of these scenarios are really that great from the perspective of the 10-year and long-term instruments, right? So you're a long-term investor, you're saying, okay, if he's a hawk, that's good. He's probably not, though. Otherwise, why would he get the job? And if he's not truly independent, that's not great either. So the independence of the Fed is one of the great achievements of the American Republic. The vast majority of countries around the world can't help but interfere with monetary policy to win the next election and preserve power. This is the instincts of people in power, and you see it here in the United States too. And that's despite all the criticism that the Federal Reserve deserves for all the mistakes it's made, including around QE, trillions of MBS purchasing, and monetization of the debt, which should never have happened, right? I think that's bearish for bonds and long-term rates. And if you own long-term bonds, I don't know why you own that. I don't know why. Not only is there a bubble in OpenAI, there's a bubble in sovereign debt around the world. There's a bubble in U.S. Treasuries. Treasury's already issuing on the short end of the curve. They've been doing that already, started under Janet Yellen. They've been doing it now. One of the mistakes of Janet Yellen was not issuing a lot of long-term debt when the 10 years are 1.5% during COVID. That was the big mistake. There's been a lot of mistakes all over the place. So we'll see. He's not my pick. But also, look, the Fed chair is one person. He's got a heavy thumb on the scale. But the FOMC has other views, and we'll have to see whether he can marshal them to his perspective. He is a contrarian. I don't know that he'll be able to necessarily swing the court in his direction. We'll see.
Well, I think Trump has already earned himself two enemies on the FOMC with Lisa Cook and Powell, right? So if they want
Yes.
to be a bit difficult, they'll play and be, a rebel and basically always vote against. But we'll
Yeah.
see. Just to finish off with, Ram, I got a few quick fire questions on the lighthearted side. So, firstly, what's the most underpriced risk right now?
And by that, do you mean the left tail risk no one sees coming?
Yeah, exactly.
I'd say, like, first off, overall, the macro picture is good. It's like a Goldilocks macro picture of declining inflation, earnings growth, the deregulation, etc. So that's the backdrop to keep in mind. The left tail risk no one sees coming. It's not the yen carry trade on. It's not that. Whatever people are talking about, it's not that. Not that. So it would be, could there be some geopolitical risk? Yes, that would be short lived. You're supposed to buy the dip if that happens. There's an armada outside Iran right now. I do think they'll take action.
China, Taiwan, that won't be too
I,
good for
I,
the
I
TSMC
I don't think
investment.
that's going to happen. I don't think that's underpriced. I don't
Yeah,
think that'll
yeah,
happen.
okay,
I think you
okay,
can buy China, and I think you can buy Taiwan.
yeah.
Uh, So I don't think that's it either. An unwind of if there was a move on Greenland that would cause unwind of NATO because they can't exercise Article 5, that could be a kind of a risk.
Yeah. But
Maybe
I think the main point is, yeah, like, if it's a black swan risk, it's like you won't know what it is, right? And it's not been priced because people haven't actually
we'll see. I mean, in the 2007 crisis, you could see the subprime risk. You could see it before it showed up. So I'm not of the view that all left tail risk is kind of you wake up one day and it's hits you in the back of the head. The left tail risks are in page 6 of Bloomberg, Wall Street Journal, or wherever it is. Like okay, here's what it is. Here's what it is. Finishing my coffee, we finally woke up. The left tail risk would be that Sam Altman's committing fraud at OpenAI and he's misled and misrepresented investors. That would be the left tail risk.
wow.
And,
Okay.
and or other financial misrepresentation from AI companies that are out there. And I do think that's mispriced. I don't trust Sam Altman. I trust him as about as much as I can, as far as I can throw him. I'm borrowing from Nick Carter's quote yesterday I heard that. I love that. I don't trust. I think there was serious possibility that could be misrepresentations. I've just seen this story before. I mean, the obligations are too high. They got to raise money. He's got to do whatever he can to raise the money. He's making promises on investor statements, and smart money's not getting involved. So I think there's
Very
a non-zero.
panic stations, kind of like the SPF raises or the FTX raises prior to,
Yeah, and look, the board fired him. His founders left. This is not like a pattern of winning and integrity. It's
yeah.
questionable what's going on there. I'm not saying that. I'm speculating here. I'm not saying that that's happening. I am saying that it's a mispriced risk.
Cool. One more question to finish off on, Ram. The biggest investment mistake or regret you've made in your investing career?
Great question. Not owning enough stocks. I used to be in the 60/40 club because I had an advisor. That was why the hell have you got to own bonds? That's number one. It's sins of omission rather than sins of commission that'll get you, to borrow from Peter Thiel. It's not investing in the winner rather than the cost of a loss. It's not participating. So I don't own any bonds now. I fixed that mistake.
Yeah, it's true. I think this is the thing. It's not owning the right. It's like not owning enough assets, especially in this environment for people who aren't invested. Like now that you've got the questions around the K-shaped economy and where the gains are going. If you don't hold assets, especially when you've got a potentially more dovish tilt coming from the Fed, if Trump's going to get his way, he's going to run the economy hot. If you don't hold stocks right now, or any sort of hard assets in this environment, you're just going to increasingly be left behind.
Yes. And related to that, it's not owning enough of your winners. When I look back, I see that I had good themes, good ideas, but I didn't own enough of my winners. So that's mainly it too. So add to your winners. We're always reflecting on that. We're always reflecting, like, we're trying to find something to buy. We say, what's working? What's winning? Is it set up? Can I buy more?
Well, thanks a lot, Ram. I've really enjoyed this conversation. We
My
covered so
pleasure.
much, and we could have indeed have gone on for hours, but it just means we have to get you on again sometime soon. And hopefully, it's not just after the crypto market has collapsed, so you can explain to us. Hopefully, it's when we're back in bull market territory and we
I
can
would love
talk
that.
about crypto again.
Thank you, Nick. I really enjoyed it. Every minute of
Yeah,
it. Real pleasure. Thank you so much.
cool.
Be well now. Cheers.
Gotcha.